Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. First and foremost, I want to wish you all a wonderful holiday season and a great Christmas to all of you that continue to listen to our podcast on a weekly basis. We're almost at 60 podcasts, and we're going strong. And obviously, I'm very excited to be here every single week with all of you, providing you with lots of education, because at the end of the day, as I always say, information without education always leads to failure. Now, today I'm going to spend a little bit of time in breaking down the taxable buckets that the IRS enforces upon all of us as we file our taxes on an annual basis. Now, the name of this episode is going to be the pros and cons of the taxable bucket. As all of you know, we do have three IRS buckets that we need to deal with on a regular basis. Now, what's interesting is that whenever we do an audit from an accounting perspective, and or a client walks into our office or they reach out to us either via conference calls or video conferences, whenever I ask what percentage of their assets they have in each and every one of those buckets that we're going to be discussing, the answer is that, first of all, they didn't even know that there were buckets of taxation that they needed to be aware of. So the vast majority of the clients that we deal with, we have to start from square one and provide all kinds of information and education along those lines. So obviously, as you have heard in many of the other podcasts or seminars or webinars that I conduct on a regular basis, there are three IRS tax buckets that we all need to deal with. We have the taxable bucket, which we're going to be discussing today. We also have the tax deferred bucket, and that bucket can be actually divided into two internal buckets, but we're not going to have the time to go into that area today. So just keep in mind that we have the taxable bucket, the tax deferred bucket, and then last but not least, and probably the most efficient of all buckets, is the tax-free bucket. So I think the importance of understanding these taxable buckets is that once you understand how the taxation of these buckets work, then you're able to do a much better job in managing your taxation, not only for today, but also for many, many years to come. One of the things that we try to strive upon with each and every one of the clients that we engage on an ongoing basis is, upon retirement, we want to reduce their taxable liability to zero. And you heard me exactly correctly. If we can do the good job for many of our clients, and we can reduce their tax liability in retirement to zero. So it really wouldn't matter what taxes are going to be in the future, and then we'll talk about that in the next few minutes. But if I can do, and if we can do as a firm, our due diligence in making certain that we can reduce the tax liability for our clients to zero, or as close to zero as we possibly can, then we've done a really good job to them. The other thing to consider as far as the importance of understanding these taxable buckets is that when you take a look at where taxes are going to be in the future, it is imperative to understand that there's a very high probability, if not certainty, that taxes are going to be much, much higher in the near future than they are today. And the reason for that is, first of all, our national debt now is almost, it's approaching pretty much $22 trillion a year. our deficit, that's the difference between what we as a country bring in every year in revenues versus what we spend out, is almost at $1 trillion. For the first time in U.S. history, we're going to be hitting the $1 trillion deficit in 2019. Can you imagine if you had to run your household, or if you ran your household and your business the same way? If you were making $20,000 a month, but you were spending $30,000, how long do you think you're going to be able to keep that up? Now, we've been able to keep that up for the last 10, 15 years because, interest rates in the United States have been extremely low. So our ability to service that debt, which is fast approaching $22 trillion, has not been as expensive as it should be and as it will be as soon as you start to see interest rates creeping up in the near future. And as you can tell, so far in 2018, interest rates have been going up. So therefore, every year that goes by is going to cost a lot more money to the U.S. government in order to service and pay the interest on the national debt. So it's important to understand that you can't have all your eggs in one basket, but also understanding how the baskets work will be very, very important for all of you, not only now, but also in retirement. Now we're going to start discussing the efficiencies and inefficiencies of the taxable bucket. Again, we're not going to be talking about the tax-deferred bucket today. We'll talk about that one next week. And then the following week, we're going to be discussing the tax-free bucket in more detail. So today we're going to be sticking to the taxable bucket, which is a very important bucket, but obviously understanding how the bucket works will make it even more critical to all of us on this podcast today. Now, what are some of the advantages of the taxable bucket? Number one, the biggest advantage that you can have in the taxable bucket is its liquidity. Therefore, every dollar that you have in that bucket is very, very liquid, and we all need liquidity from time to time in our lives. Now, one of the great things about liquidity, and one of the great things about having a taxable bucket or assets inside a taxable bucket, is that it gives you the ability to mitigate short-term emergencies if you have any. Let's say you lose your job, or if you're married and your spouse loses his or her job, the taxable bucket is readily available to do certain things. What if you need to fix something in your property, your apartment, your condo, your home? You have money that is readily available in order to do that. Now, the other advantage that you also have with the taxable bucket is not only does it provide liquidity and the ability to mitigate short-term emergencies, but also gives you the ability to take advantage of opportunities in the marketplace. And it could be financial opportunities. You may be able to pick up a piece of property if you happen to be in the real estate business, and you can pick it up overnight just by being able to write a check. So that's going to give you the leverage that the vast majority of Americans do not have when it comes to their finances. The other issue to consider is that when it comes to the taxable bucket, you also need to have the right amount of money inside of that bucket, because what I do find from the audits and the reviews that I do with new clients as we engage each other from a financial perspective is that the vast majority of Americans that are tax-paying Americans, and I say tax-paying Americans because 40%, approximately 40% of the U.S. population does not pay any income taxes whatsoever. But one of the challenges in the taxable bucket, and one of the challenges when we do these audits, is that we find that the vast majority of the people that we audit are actually paying a lot more in taxes than they need to. And the reason for that is that they have more than adequate amounts of assets inside their taxable bucket, and therefore they're going to have to pay taxes on an annual basis on the money in the bucket and the gains inside of that bucket. Now, the other question is, well, if that's the case, Bert, how much money do you feel that we, let's say a family, a husband and wife, we should have, or you should have, in your taxable bucket? And obviously, the numbers can vary a little bit, but not too much. If you're married, filing jointly, so husband and wife, that file their taxes annually as a joint return, and there's only one income in the family, then I would suggest that you need to maintain 6 months of monthly expenses. Could be just fixed expenses if you happen to be quite aggressive. But if you happen to be very, very conservative, then the 6 months should include not only your fixed expenses, but also certain variable expenses along those lines. So that's important to understand, because obviously there's only one income in the family. And if you happen to be that provider or the provider of that income and you lose your job, then obviously having 6 months in your taxable bucket is going to be more than suitable, and it's going to give you the peace of mind to be able to move forward as you attempt to find another job or start a new career or start a business or whatever that may be. Now, if you're married, filing jointly, and you have double income in the family, you have two incomes in the family, so both the husband and wife or the partners are actually working, then I would suggest that instead of having 6 months of monthly expenses, you only need to have 3 months of monthly expenses. And again, it could be either fixed, either variable, or a combination of both. And the reason why I would recommend 3 months instead of 6 months is that, if one of the spouses loses his or her job, then obviously the other spouse is continuing to work and is continuing to generate and bring revenues on a monthly basis to the household. So you would only need to offset one of those incomes for the short time being, so that other spouse then figures out what he or she is going to do in the very near future. So again, having the proper amount of assets in the taxable bucket is quite important when it comes to liquidity, mitigating short-term emergencies, business opportunities, obviously issues and concerns, whether you have one income or dual income in the family, and so forth. The next topic that we should discuss is, well, if we have already talked about the advantages, then what are the disadvantages, and why is it so critical to understand how this bucket can provide some pros, and by the same token, some cons that we need to be aware of. Number one, the disadvantages is that this bucket from a taxable standpoint is a horrible bucket to have. You see, the advantages that everything is very liquid, so you have a lot of liquidity, but the disadvantages are that because of its liquidity, it really does not shelter any tax liability whatsoever. So the money that you put into this bucket, is after tax. Every single year, you will know that you're in the taxable bucket because you're going to be receiving a 1099 from the institution where your money is, depending on the gains that you had in that bucket or in that account at that institution. So you're going to have to report those gains every single year for tax purposes. And then obviously when you take the money out, especially if you're dealing with mutual funds and you sell that portfolio, then if you have a gain, you're going to have to pay taxes on that gain. It could be, a short-term gain, or it could be a long-term capital gain, or even a short-term capital gain. So the bottom line for the disadvantages of this bucket is that the money that you put in is taxed. the growth in that bucket is taxable to you and your family and or your business on an annual basis. And then when you liquidate the account in the future, you may be susceptible to additional taxation. Now, what are some of the vehicles that form part of the taxable bucket? Well, you have your CDs, you have your traditional mutual funds, you have your money market accounts, you have your savings accounts. So all of those vehicles are in the taxable bucket. So as you can see, there's a high liability from a taxable standpoint, and there's no tax deferment and or tax postponement from a business perspective. So now I guess you can understand and you start to see why mitigating the amount of assets that you're going to maintain in this bucket is going to give you the ability to mitigate those tax liabilities as you move forward into the future. And one of the main reasons why you need to be aware of the tax liability of this bucket is that, if you don't do this properly, over a 30-year period, you could have taxable implications that could exceed $200,000. So, if you're able to avoid the exorbitant amount of taxation in this bucket, you can actually save up to $200,000, sometimes even more, depending on how much you keep in that bucket from a taxable perspective. Can you imagine if you're able to limit that and take all that money throughout all those 20, 25, or 30 years and put them into a tax-free account? How much more would you have, at the end of the day, in which you can actually control the tax liability of that bucket? And we'll discuss that in 2 weeks from now when we get more into the tax-preferred and or the tax-free bucket. So again, disadvantages, everything is taxed out of that bucket. And then obviously, the taxable implication not only is the tax liability that you're paying for the given year, but also the opportunity cost on that tax liability. You see, if you can avoid paying a certain amount of tax in any bucket, then obviously that money can stay on your side of the ledger. And then if you are able to invest that money, earning anywhere between 3, 4, 5, 6, sometimes 7 or 8% return on your investment, obviously depending on what type of investment you invested in, it may not be guaranteed at all times, but at least you're also recapturing the opportunity cost of what you could have done with that money had you not had to pay it to the IRS from a taxable standpoint. So I think it's very important to understand that, yes, all of us need to have money in the taxable bucket because of all the issues that we have discussed. But understanding the leverage and how much money you should be keeping in that taxable bucket is going to be paramount in order to determine success or failure in the future from a business perspective. Final thoughts regarding a discussion on the taxable bucket. Number one, I think it would be critical to limit the amount of assets that you have in this bucket. Remember, we covered, if you're married, filing jointly with one income in the family, it should be 6 months. If you're married, filing jointly with dual income in the family, it should be not more than 3 months. You could have a year where you're about to make an investment, so you may want to, have more money in that bucket. That's okay, but it's only for the short term, not to keep it there for the long term, because then you're going to be increasing your tax liability to a level that you shouldn't have to. Legally, you shouldn't have to do that. There's a big difference between tax avoidance and tax evasion. Whenever we do tax planning for our clients, we want to make certain that we can take advantage of all the tax loopholes that the IRS makes available to all of us from a legal standpoint in order to maximize the return on our investment while minimizing the amount of taxes that we have to pay to the IRS on those investments as well. Now, once your taxable bucket is properly funded, then it gives you a lot more leverage from areas that many of the clients that we engage have never considered. You see, if you have auto insurance or homeowners insurance or umbrella policies, and you're paying a premium on an annual basis, many of the clients that we have engaged have a tendency to reduce the deductible, but when you reduce the deductible on an insurance contract, then you're actually increasing the premium. And I'll give you an example. Many times when I do reviews with clients and we review their auto policy, obviously we work very closely with their property and casualty agent. One of the things that we notice is that in their auto policy, they have a $250 deductible. And one of the questions that I would ask the client is, Mr. Client, if you have a fender bender and the cost of of fixing and repairing your vehicle is $250, are you going to be reporting that cost to the insurance company? And most of the time, the clients will say, well, Bert, more than likely I will not, because if I do, then there's a probability that my insurance premiums would go up the following year, so I would rather pay for the damages myself along those lines. And then my subsequent question would be, well, what if it was $500 of damages? Would you then report make that report for damages to insurance company? And many of my clients will say, nah, not even $500. I'd rather pay it out of pocket, because if I do that, then obviously I'm not going to get my insurance contracts and my insurance policies increased the following year. And then my final question is, well, Mr. Client, at what point in time would you actually reach out to the insurance company if you have automobile damages and that you need to fix and or repair? And some of them will say, well, it would have to be at least $1,000. So then my reply to that is, well, if you're not going to report an accident to the insurance company under your property and casualty insurance policy, unless the damages are either $1,000 or exceed $1,000, then why would you want to pay a higher premium for a lower deductible of $250, which you're never going to be using to begin with? Wouldn't it make more sense for you to increase your deductible from $250 to $1,000, reduce your annual and or monthly insurance premium? Because if you do have a fender bender, your emergency fund inside of the taxable bucket is going to be able to cover that without any problem whatsoever. But now you're recapturing a portion of that premium that you would have paid to the insurance company anyways without getting anything for it, because you would have never reported an incident to the insurance company unless the damages are either at $1,000 or exceed $1,000. You see, the problem that we have is that the vast majority of Americans, when they make financial decisions, they make those decisions in a vacuum. They make micro decisions without really considering making decisions or looking at their financial decisions through a telescope as opposed to a microscope. So again, that's just one example that gives you the leverage to understand how important it is to have a clear vision of how your taxable buckets work and what they can and cannot do for you and your family along those lines. Obviously, once your adequate limits are reached, then it's important to start shifting your annual after-tax earnings inside the taxable bucket onto the tax-free bucket, and we'll discuss that in a couple of weeks from now. So that means that, if you leave that increase after you pay the tax inside of that taxable bucket, now that taxable bucket is compounding itself. Yes, the assets inside the taxable bucket are compounding, but so is the tax liability. So in a perfect world, you want to have the bucket to be compounding from an asset perspective, but you want to limit and or negate the tax liability out of the bucket as well. And unless you do proper tax planning, you're never going to be able to accomplish this. One final thought before I leave you is that, there's a big difference between tax preparation and tax planning. Most of the clients who we engage have never done tax planning. They've only done tax preparation. Unless you do proper tax planning, you're never going to be able to reach the proper distribution out of all three taxable buckets in order to mitigate and or reduce your tax liability to either a 0% and or as close as possible to a 0%. I always leave you with a statement that I make every single time, whether I'm doing a seminar or a webinar or a podcast, because it's something that I'm a true believer in. And that's a fact that my goal is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see will always change. Again, if you need to reach out to me in order to discuss any of these issues, please feel free to reach out to me at 786-1042, or you can send me an email at Bert, B-E-R-T, at gablestaxgroup.com. Again, have a wonderful holiday season, and I'll talk to you again next week. Take care. Bye-bye.